Saving cash in a bank won't make you wealthy. You won't get rich by saving money in the bank. Maybe you want to be able to retire with $1 million, or perhaps you'd like to accomplish that goal much sooner, perhaps by the age of 40 or 45. It goes without saying that in order to amass riches, you must spend less than you make and save the difference. But simply saving money won't cut it. Additionally, you'll need to invest your money to put it to work. Here are a few clever methods to go about doing that. It might be difficult to put personal finance advice into practice and save money. It can take years of consistent saving and extreme self-discipline to accumulate enough money for an emergency fund, much less a down payment on a home, retirement, or a child's college tuition. First, listen to this story. A middle-level manager who is currently employed in the Middle East wants to return to India. It will be simpler and less expensive for him to educate his children in India than to try to send them somewhere when they will need to attend college. He'll still fork up the premium. When they return, he and his family intend to reside in one residential flat. 2 more houses have been purchased on the outskirts of the city. One is occupied by the wife's parents, while the other, which has leaky and cracked walls, is locked. Every monsoon, flooding occurs there as well. He regrets his hasty choice. During their trip abroad, his wife was able to purchase about X grams of gold. She is very happy with her money and thinks the investment is evidence of their success. She won't consent to give any of it up for sale or pledge. The daughter will receive half of it, while the other part will stay in the bank locker to be worn on different occasions. The stock selection in the investment portfolio is a jumble of securities acquired on the recommendation of friends and family. The majority are losing money, but some are doing well. There are a few insurance plans and bank deposits. His investments during the previous 5 years may not have been wise because mutual funds are newcomers to the portfolio. His entire worth is rupees 5 crores. Real estate assets are worth roughly around 3 crores, while gold is worth roughly rupees 1.25 crores. Deposits are at rupees 25 lakhs, equities are worth 20 lakhs, and mutual funds are worth 30 lakhs. His main concern was that mutual funds appear to be rising and falling. Has he made a mistake? He claimed that over 9% of his portfolio is still unavailable and useless, and he is concerned about the remaining 10%. He feels wealthy and prosperous. He continually expresses his pride in their success to me. Given where he started and how arduous it was for him to get where he is now, this is reasonable. I advise him, let's start by listing your financial objectives. Education, marriage, and retirement are on the standard list. The short-term objective that will be accomplished during the next 5 to 7 years is for his children to attend college. As soon as he returns, he will have to pay for the coaching classes in addition to private school. He will also need to locate a job and a reliable source of money. He has ideas for starting a business and for working as a consultant or an advisor, but he is unsure about his present course of action. He intends to leverage the financial investments to get started. I inform him that you need money for the next 40 years, and he is surprised. The asset portfolio doesn't contain any assets that can be used to finance short-term objectives. There are no assets that will generate the income he needs, and therefore, he is not ready to retire. He needs a corpus that will work for him, and with rupees 75 lakh, 1 minus the funds needed for immediate education goals, there is too little left. He needs to sell 2 of his houses to generate funds. Since the third house is tough to sell, the second must go, even if it is a tough call. His in-laws can live with them, live in a simpler rented property until the situation stabilizes. The wife needs to be willing to sell some of the gold so that the money can be used to buy financial assets that will grow and be available for use as needed. The financial assets should be at least half or more of his overall assets so they can work for him. He didn't seem confident in his ability to negotiate these significant adjustments. I informed him that if he was unable to accomplish this, he would need to continue working in the Middle East for at least the next 5 years while managing his children's education, saving for his retirement, and investing his income in a different manner. He would then be allowed to return to the country after that time. It's cruel, he thought. Yes, it is. However, investing all savings in real estate and gold typically has negative results. He questioned, is this not something out of a textbook? That could be the case, I said, but what are your options right now? Instead of using a few options available right now, what would you change? Property and gold are tough to sell, even tougher to use for their income or gain. Many immigrants build mansions that are incapable of being rented. They want their families to enjoy the benefits of their high earnings. Commercial property that can earn rent is not on their minds. The lure in these assets is visible. They raise one's social standing and advertise to the rest of the world that this family is wealthy. People enjoy this kind of focus. People are happy that the assets are increasing in value while they are still being developed. The financial crunch is only experienced when the goals in terms of money need to be funded. The decision to use whatever financial resources are accessible at the time is still up for debate, and this investor is likely to choose to do so. He said, "There won't be a problem as long as we have a house to live in and choose a simple life. Children will simply have larger, unrealistic expectations as a result of this. People don't give much thought to the possibility that their retirement is in danger." Here, he is still a young man. The family's financial situation will improve after another decade of high-paying jobs. Traditional beliefs like a single source of income, owning land and gold, making sacrifices for children, and wanting to go back home early won't pass the sensibility test. It was a wrong choice, but it does play on passion and emotion. The Middle East-placed man believes himself to be a hero, an achiever, a martyr, and a self-made millionaire. While bank fixed deposits, FDs, are low-risk money market instruments and offer several benefits, including guaranteed returns and flexible tenor loans facility against an FD. An investor looking for a balanced investment portfolio can find a number of banks and NBFCs offering FDs in India. As an investor, you may be worried about declining FD interest rates. Here is the solution. You have an option of corporate company NBFC FDs. Corporate FD rates are higher than bank FDs. Investors seeking to avail greater returns while ensuring the greatest capital protection can open a corporate FD account. Let us understand corporate FDs and find the reasons behind considering corporate FDs to gain better returns. What are corporate fixed deposits? Fixed deposits offered by companies and NBFCs, non-banking financial companies, are popular among investors as corporate or company deposits. Corporate FDs are similar to bank FDs in terms of assured returns, flexible tenor. What makes corporate FDs an attractive investment is that they offer higher interest rates than bank FDs. NBFCs, or companies issuing FDs, adhere to stringent regulations laid by the Reserve Bank of India, RBI, or Ministry of Corporate Affairs, MCA. All relevant information regarding the corporate FDs has to be disclosed to the RBI. What makes it a preferred investment option? Following are the features and benefits of corporate FDs that benefit investors. Safest investment option. FDs are considered amongst the safest investment options with ratings from leading rating agencies like CRISIL, CARE, and ICRA. The minimum rating is BBB, above investment grade. If you are an individual hesitant to invest in the capital market due to uncertainty and fluctuations, an FD is for you. Intended for wealth creation, and predictable cash flows in the longer run. Assured and greater payoffs. No matter how much the inflation and how uncertain market situations are, you will get the benefit of assured returns irrespective of any change in the FD rates in the interim. Once you have invested funds at a specific rate, you will continue to receive the interest on that rate till maturity. As mentioned, corporate FDs offer higher interest rates than bank FDs and post office FDs. You can deploy your funds here to make higher returns. Additional interest rate benefits. You can find a financial institution offering additional incentives to depositors. Generally, these incentives are for online investing and renewals. Depositors' income increases slightly with such benefits. An investment for everyone. All individuals, non-resident Indians, NRIs, and senior citizens can invest in corporate FDs. Rules for NRI investors may vary by the financial institution. Higher interest rates for senior citizen FDs. Senior citizens FDs offer the benefit of higher interest rates that support their livelihood further. NBFCs add an extra interest rate to FDs in the name of senior citizens. Loan against FD. Financial institutions can provide a loan against FD to help you meet your urgent financial needs. Periodic interest payouts. Corporate FDs can be cumulative or non-cumulative. A non-cumulative FD allows depositors to opt for periodic interest payments. You can choose from monthly, bi-monthly, half-yearly, or annual payouts as per your requirement. It is an attractive feature for dependents on their investments like senior citizens. Flexible tenor. Corporate FDs offer a flexible tenor to make deposits. Depositors can choose from 12 to 60 months that suits best to meet your financial goals. Fixed deposit calculator. Depositors can utilize an online FD calculator provided by the NBFC to calculate the interest and maturity value of an FD even before investing their funds. Lower penalty period. The penalty period for early corporate FD withdrawal is lower as compared to bank FD. RBI does not permit the withdrawal of an FD in the initial 3 months of the tenor. If you do so, you will be levied a penalty for early withdrawal. You will get an interest rate that is applicable for the reduced tenure. The ease of investing is also one of the reasons for favoritism among investors. With these benefits, you may have got the idea of how corporate FDs help you in wealth accumulation. Let us ponder more over these points. Where to keep your emergency fund? The majority of financial experts concur that you should have enough money in your emergency reserves to cover 6 months' worth of living expenses, although the precise amount depends on your financial security. 3 to 6 months' worth of spending, according to Lauren Anastasio, a certified financial advisor at SoFi, is a decent guideline. You might be able to get away with putting less money, only 3 months' worth of expenses, into your emergency fund if you work in a stable industry, are in good health, and reside in a region with a low cost of living. However, if there's a possibility that large expenses or layoffs could arise in the future, saving more money may be a wiser move. If you keep your savings in a bank account rather than an investment account, you can access them whenever you need. But you also have a lot of money sitting in one location, losing value as a result of interest. Keep your emergency fund in a high-yield saving account to preserve its worth. Interest rates have fallen as a result of the coronavirus outbreak and the economic downturn. Meanwhile, if you're looking for a place to keep your cash savings, look into current rates and choose the bank with the best interest. Interest rates will probably increase once again as the economy expands. Put your money somewhere safe, keeping it in mind that the majority of online banks give better interest rates than their counterparts in traditional banks. How much to put in your checking account? What do you do with your checking account now that you have so much money stashed away in your savings account? You usually deposit your paychecks into this account, use it to pay bills, and use it to fund daily expenses. So you need to have money in it. However, checking accounts are also known for paying very little interest. So the money you keep there isn't earning you any money. Because everyone's monthly expenses vary, there isn't a one-size-fits-all solution to how much you should keep in your checking account. To choose how much to leave in the account, there are a few options. Stash Wealth advises a $2,000 to $3,000 cushion at most to account for the ups and downs in your financial situation. This amount may be a little high for some people, especially if their expenses are on the low side. Yang advises figuring out the optimum figure for you based on your requirements. Yang advises customers to estimate their monthly costs and set aside enough money in their checking account to cover them. Any extra money they have should be moved to something that earns a higher yield, said the advisor. According to Anastasio, it depends on how much reserve money you feel safe keeping on hand. But generally speaking, she says, a good rule of thumb for your checking account is to keep the equivalent of one net paycheck. This ensures the amount is right for everyone regardless of income level. Thank you, Brain Grain family. If you liked this video, then do like the video and subscribe to the channel immediately. And if there is any topic on which you want to see our video, then do tell us by commenting. See you soon with another amazing video.